So, the autumn budget has just been announced, and there are going to be some major changes affecting the property investors in the UK. So, in today's video, we're going to be breaking down the key points, or my key points, from the 2025 autumn budget, what it means for renters, for landlords, for first-time buyers, and just basically property investors across the UK. There's been a lot of discussion, there's been a lot of different headlines, a lot of confusion. So in today's presentation, I'm going to try and simplify it, break it down into layman's terms as simple as possible and make it straightforward and just really get at what really matters for you as an investor. Greg Parker here from Parker's Property Sourcing. It's coming at you with another video today. And today we're discussing the winter autumn 2025 budget, basically. As you can see, the last 13 days I've been doing daily videos on 14 different property strategies. But with the Chancellor doing her speech today, I thought, you know what? I've got to add another video. So 2 are going to be posted today. And I just really wanted to just give my outlook on what this budget means for us as investors, basically. So the budget's important because the government need to raise around £26 billion, basically, to cover a gap in public finances. So instead of increasing income tax or national insurance this time, the Chancellor has announced an extension of the income tax threshold freeze until 2030. So what does that mean? So for me, my take on it is, as the wages go up, more people will naturally move into higher tax brackets. So that's without the government officially raising tax rates. Yeah, you know, people call this the fiscal drag. That's what I've been hearing, the fiscal drag. And it affects everyone from workers to buyers to landlords because it reduces disposable income and changes the affordability in the market, basically. So that's what it means. That's the shift that we're going to start to see. And one of the biggest headlines was the introduction of future tax on high value homes, basically mansion tax. So that's not going to be immediate, but the plan is to begin to tax properties valued over £2 million, starting in 2028. There was also discussion around reforming stamp duty tax. So not necessarily removing it, but potentially changing how and when it's paid. So what that looks like, it could look like, is instead of you having to pay when you are about to complete on a property, maybe they'll do it. You don't pay them, but you pay a monthly fee over a certain amount of years, for example. Another change was to cash ISA allowances, which are being reduced. So that will affect savers and could push more people towards alternative investments like property. Yeah? Because the returns elsewhere are also being tightened now. So who benefits? So I would say, based on what's just been announced, there are a couple groups of people that I think would benefit. So I think first-time buyers may benefit if stamp duty reforms, because what that will do, it will reduce upfront costs. Investors that focus on cash flow, especially your buy-to-lets, your HMOs, also stand to benefit because demand for rentals is expected to rise, of course. Definitely regions outside of London and the southeast may see increased activity, which I'm seeing a lot of, particularly up north in Newcastle right now and in the surrounding areas of Newcastle, because more buyers and investors will look for affordability. Yeah, so people are going to be going where it's a little bit cheaper, easier to enter the market. And then I think finally, renters could benefit in the long term if more housing investment comes through as planned. Obviously, that just depends heavily on delivery because, you know, the UK always want to create a certain amount of houses every year, but they always fall short. So that's a big factor as well for renters. So where there's a winner, there's a loser usually. So on the other hand, there are groups who may feel some pressure. So I would say owners of homes over 2 million, they're likely going to face higher tax obligations in the near future. Also, people that are savers that rely on high ISA limits now have fewer tax-free saving options, as I mentioned. And investors who buy purely for capital growth, especially in high-value markets like London, you might just need to start to adjust your strategy. And anyone buying expensive properties in the southeast could see slower price growth and lower exit demand. Because as I've said, people are going to start, trying to invest where it's more affordable, as opposed to, down south with capital growth and the taxes and so on and so forth, So for me, over the last few years, I've been investing up in the northeast. And the shift in the market, and for me, one of the biggest takeaways in how this budget could influence where demand goes, is that we're already seeing homes in areas like the northeast selling much faster than homes in London and parts of London. In some northern locations, properties are selling in under a month, whereas in London, in many cases, it's taken more than 100 plus days, to sell your property. So with affordability tightening and taxes rising at the top end, more people may shift to areas where they can buy, live and invest at much, much lower costs. So that's the shift in the market I believe is going to happen over the next couple of years, and it's going to be a major shift as well. So if you're watching this and you're a new investor and you're thinking of where to invest and when to invest, I would say now, because it's still affordable in good little pockets up north to get yourself good returns, good buy-to-lets or different strategies, but get yourself good properties. But when that shift starts to happen and everybody starts moving, there's going to be less available, which means, supply and demand, which means prices will then start rising because everybody's now invested in a particular area in the UK. So, what would smart investors do? So for investors for me, the strategy now is to adapt, really, and not panic. So the focus should be on, properties that generate strong rent, which I always talk about, predictable demand and solid yields. So what does that look like? That includes single lets, HMOs and supported living, of which I don't have a HMO at the moment, but I definitely have a few single lets and I have a few support on my properties are rented to supported living companies. Again, the areas with strong rental markets, you need to be looking out for now, because investors should avoid buying emotionally now and instead make decisions based on your numbers, the rental income, supply and demand data, because if stamp duty reform goes ahead and if the mansion tax model is confirmed, the market will likely reward affordable areas and shrink premium only investment demand. So that's that in a nutshell. So smart investors will now start to adapt and look into more affordable areas that are giving you good return on your investments, particularly in supported living. So why this could be a turning point? What does this look like for an investor? So the budget may become a turning point for the UK property market because for years, people have tried and relied on capital appreciation, which I do too, which we all do. And again, if you're an investor like myself, I'm investing for the long run, the long term, not short term gains, long term gains. Property's still going to double in value every 10 years. Yeah, that's not, I can't see that changing. However, the budget definitely signals a shift towards property as an income asset, not just a wealth storer. Yeah. So with interest rates stabilizing and affordability under pressure, rental demand is just going to start going up and up and up, basically. This is what happens. So for me, looking at it as an investor, property with cash flow is definitely more attractive than speculative growth. You know that your property is gonna, if you buy in a good area, strong demand, you know that it's gonna double every 10 years, but you're not buying it for that. You now want to be looking at buying for good return on your investment every single month. Good cash flow. So to summarize, for me, my summary is taxes are tightening. They've got to get that 26 billion from somewhere, especially at the high end, though. Some buying costs may reduce if stamp duty changes, which we'll keep our fingers crossed for. The ISA rule change may push more people to invest rather than to save, which would be the smarter thing to do. And the biggest opportunities appear to be in affordable housing and the rental-led strategies, you know? So the key is to adapt to the new rules, not to fight them. That's what I would really say. You've got to adapt to the new rules, don't fight them. So just to conclude my video, I want to hear from you guys. Do you think property prices will rise or fall after this budget? Just comment rise or fall. Tell me where you're based as well, you know. Also hit the like button, subscribe if you want to, you know, keep informed, keep up to date, and you like my outlook on, you know, how I talk about and how I view these property opportunities, changes that are constantly happening in this UK market. And just to end, I'm on day 13 of my 14-day UK property strategies. I'll leave a link in description. Check them out, because there might be some strategies there that you've never heard of or never thought about, and I touch on it, you know, and it can give you different ideas on how you can enter the market. Some of the strategies I speak about doesn't even need money to start off with, but you'll be getting yourself into property, you know. So really hope you've enjoyed today's video. I've been Craig Parker. Till next time.